Hello there, everyone. So I thought I'd record a video to discuss cash flow and accounts receivable turnover and why it's important to a business. Well, in my perception and my experience as an accountant, it's important for two reasons. One is cash flow, and the other one is bad debt expense. So as you remember, a lot of times whenever a sale is made or revenue is brought in, you debit either cash or accounts receivable, and then you credit your revenue. Therefore, if there's a lot of transactions showing up in the accounts receivable account, in other words, you're taking a lot more accounts receivable than you are cash, you haven't really done the complete transaction and completing the cash, which would later be a debit to cash and then credit to accounts receivable, which would reduce down that accounts receivable account. So therefore, it's possible to stack up a lot of revenue, and then you're stacking up a lot of accounts receivable. And then if you never collect on that accounts receivable, say a lot of your clients go bankrupt or they go missing, or you just can't collect it from them for whatever reason, which does happen quite often, then you have a lot of receivables but no cash. And then whenever it comes time to pay your bills, pay your employees, or invest in infrastructure for your company, you won't have any cash on hand to do so. And therefore, with employees going unpaid and vendors going unpaid and not reinvesting in your business because you don't have the cash from the sales that you've made or the services that you provide or the products that you've sold, then your company is going to go on the downward slope. Is going to hurt your performance as an overall company and hurt your ability to serve the customer, which I think is the most important aspect of a business, which is serving the customer. Therefore, it's very important to collect on these receivables. And then if you don't collect on these receivables, it's going to start showing up in your net income. So even though you're making plenty of sales, then eventually the bad debt expense is going to be debited and the receivables will be credited. Therefore, the more expenses that build up through bad debt expense will directly take away from your net income on your income statement. So if you don't collect on your receivables, first it'll show up on your cash flow statement, and then it's going to show up on your income statement through the bad debt expense, which then downgrades your net income eventually, which is going to show up to your investors even more, so from the cash flow statement and then from the net income or from the income statement. So I hope through this video you see why cash flow, why accounts receivable turnover is very important. A lot of small businesses fail each year because they don't keep enough cash reserves on hand and they don't collect on the receivables. Remember, if you don't think someone's going to pay the bill, just don't make a sale to them just to make a sale and stack up your revenue, because eventually you will lose out on that because you want to collect the receivable, you won't be able to pay certain bills or reinvest in your company, and then eventually it will be written off the bad debt expense. So accounts receivable is very important and probably one of the most, in just my perception, most overlooked areas of business from small business owners whenever they first get into business. So hope this helps everyone.